This morning's inflation report finally gives us the catalyst we need to lower rates, for the Fed to lower the Fed funds rate, and for home buyers to get back into the market. We're going to take a look at inflation. We're going to take a look at VA rates. They're coming down, as are conventional rates. But we're also going to see what cracks are in the armor for the U.S. economy. All right, let's get going with the housing market update. You're not going to want to miss this. All right, the big three: prices are steady. Inventory is steady, actually rising across country, and rates are down. That's why I'm smiling right now. And we're going to get into some of this headline news. Inflation is finally starting to cool off. Yes, it is. But there are cracks in the armor of our economy. We're going to go over that. We're going to go over one of the benefits of the One Big Beautiful Bill Act that was passed earlier this year. You're going to love this if you're a homeowner or a prospective homeowner. Existing home sales report came out this week, and that was a pretty positive one considering the market that we've been in. And finally, we'll get into interest rates. But let's get into the first one, and that is today's inflation report. Now, you know me, I love myself some graphs, and this graph here is the core CPI, the core consumer price index, and the core rate is what we are looking at when it comes to inflation reports, because the core takes out food and energy prices, and food and energy prices are typically more volatile. But what you can see since May of 2024, you see inflation, core inflation going down, and we just dropped from 3.1% down to 3%. The expectation was that we would be at 3.1%, and guess what? At 3%, that is good news. Now, we're not near the 2% that the Fed wants, but what we want to see is steady Eddie progress, and that's what we got here. And we'll break down this report a little more. The headline CPI, it actually increased by 0.3% in September. Expectation was that the inflation would go up to 3.1%, but it actually was at 3%. And the increase was largely driven by a 4.1% increase in gasoline prices and a 1.5% increase in the higher energy index. Food prices did edge up 0.2% in September, but again, the food and the energy prices are not accounted for within the headline because, again, they're volatile. Shelter costs actually continue to climb, which is contrary to what we're actually seeing in the market today. So it just shows that there's a big lag in the information that is being processed with the shelter cost. Declining categories, areas where we saw inflation come down: used cars, motor vehicle insurance, and communication services saw price drops. So how does the market react to this? Well, the report is seen as mildly encouraging for the Fed Reserve, suggesting that inflation is under control despite the tariffs. Inflation is steady, and economists now believe that there's a 100% chance of a Fed rate cut in October and near 100% rate cut in December. Now, the question is, will it be a 25 basis point cut or a 50 basis point cut? 50 basis point cut will be a positive surprise, and that will bring interest rates even lower. Now, let's talk about the signs that our economy is shaky. It's on shaky ground. The first big crack, and one of the biggest tellers, is rising auto repossessions. That's right. Car repossessions have surged to their highest level since 2008 financial crisis, with 6.4% of subprime borrowers at least 60 days behind on payments. That's double the 2021 rate. And economists warn that this is serious because car loans are typically the bills people are least expected to skip. Why? Because they can get away with not paying their rent, but they can't get away without paying their car bill because they use their car all the time. They use their car to get to work. They use their car for entertainment. So if consumers are skipping auto payments, that is a sure sign of economic weakness on the consumer's part. The second thing is we have a weak labor market. That's right. For 2 of the last 3 months, the ADP, the private sector jobs report, has shown declines. first time we've seen that since the beginning of COVID. And then the Bureau of Labor and Statistics jobs report, which we missed this last month because of the government shutdown, has also shown a negative number over the last month that was reported. And there are more companies that are laying off employees. Matter of fact, not including the administration basically riffing a bunch of federal jobs, Target just announced an 8% decrease in employment over the course of the next several months, and other companies are following suit. The fact that AI and automation is taking many of these jobs away is something that we need to continue to pay attention to. But I will say this, that the labor market is weakening right now. The third thing that we're seeing is an inverted yield curve and credit tightening. The Treasury yield curve remains about 23% inverted, historically one of the strongest predictors of a recession. Meanwhile, a credit-based recession probability has increased, nearly doubled since January, as banks continue to tighten their lending standards. And also loan delinquencies, as we talked about with auto recessions, but loan delinquencies continue to rise. Here's number 4, the falling consumer confidence and spending. The Conference Board's Consumer Confidence Index dropped to 97.4, with the expectation component falling even more sharply, down to 74.8. Personal spending has flattened, suggesting that households are starting to conserve cash amid worries about job security and inflation. The middle and lower class right now are on the struggle bus with their credit. The only people who are spending right now are the people who are in that upper 10% or the upper class. And then finally, we have weak industrial manufacturing output. Industrial production fell 0.1% in July, and the U.S. leading economic index logged its steepest drop since early 2025. Manufacturing new orders and average work hours declined, both consistent with an economy showing across multiple sectors. So each of these trends, from household distress to slowing factories, points toward a fragile economy, possible stagflation, and maybe even a recession as we head to the end of 2025. Hey, let's talk about SALT and why SALT is good for your wallet. SALT is the state and local tax break that was put into the One Big Beautiful Bill Act, H.R. 1, and let me tell you, this benefit is very big for home buyers, especially when it comes to taxes. The biggest benefit here is that it increased the SALT deduction from $10,000 to $40,000. So you're able now, instead of deducting $10,000 in your state and local taxes, to include property taxes, going from $10,000 to $40,000. That's huge. That's a huge benefit to people who own homes, to real estate investors as well. So what does this mean? Really, many current and prospective homeowners will be able to receive these federal tax benefits for owning and purchasing your home, i.e. you're going to see lower taxes. This One Big Beautiful Bill Act, or at least the SALT implementation, is only good until 2030. After 2030, it'll actually have to be written back into the code so that that tax break can continue. But that is a great benefit. Another reason why home ownership is a valuable thing towards establishing your financial legacy and lowering that tax bill. All right, let's also take a look at existing home sales. That's one housing report that came out this week. And existing home sales are up 1.5%. It's a little below expectations, but still 4.1% better than last year. And you can see the annualized pace of existing home sales continues to go up. Now, we would like to see 5 million, but 4 million, 4.06 this last month in September, that is also a good thing. It's trending in the right direction. The median price actually down from 423,000 to 415,000, and days on market and inventory continue to increase. And this is across the country. It's not specific to Oahu. You're seeing pretty steady output in existing home sales for Oahu, as we talked about earlier this month. There are 4.6 months supply of homes. That is on average, and that shows a balanced market. And hey, all cash buyers about 31%, and first-time home buyers, hey, they went up from 28% to 30%. So first-time home buyers are starting to get back into the game. Why? Because interest rates are coming down and because there is a large amount of inventory, which is giving first-time home buyers that opportunity they need to buy a house. And let's look at VA rates. VA rates continue to stay below 6% this week. We're right around 5.9%. This is the average again. This is not my rates specifically, but these are kind of where we are across the nation. 5.9%. I would expect that number to go down and get closer to 5.75 as we go through the day and the news disseminates that our inflation has actually cooled. So great look there, and you can see VA rates are at the lowest they've been in the last year, and almost 13 to 14 months. So good news for VA rates as we head into the weekend. And my expectation on rates is we're going to see a big drop. And when the Fed makes their announcement next week on the Fed funds rate, basically the expectation that they are going to do this rate is already going to be baked into interest rates. So I don't expect to see rates drop after the Fed drops the Fed funds rate as much as they will drop before in anticipation of the Fed fund rate drop next week after their meeting. So what does this mean for buyers? Well, mortgage relief window. We have a mortgage relief window right now. The average 30-year fixed rate is dipped to about 6.19%, which is the lowest level since mid-2024, thanks to falling treasury yields and expectations of another Fed cut by the end of the month. And we also are seeing that the most affordability that we have seen in the last 3 years, with home prices steady to falling a little bit and interest rates coming down. So really, not to say it's affordable, but it is the most affordable we have seen in the last couple of years. And with sellers giving massive credits, it is making the purchase actually affordable for many home buyers, especially VA buyers who don't have to put down that down payment, that 0% down payment. Mortgage apps actually have not rebounded yet, at least for purchases. They were down 5% last week, although they were up 8% for refinances and are up 81% year over year on refinances. So if you have an interest rate in the sixes, now is the time to get your application in and lock in savings of up to and maybe even a little more than 1% drop in interest rates. Our mortgages, every person that I'm locking in right now is probably in the low fives, high fours on 5/1 ARMs. The 5/1 ARM rate is much better than 30-year fixed rate mortgage right now. We're seeing probably about a half a point to a quarter point better on ARM rates, adjustable rate mortgage rates, versus the 30-year fixed rate mortgage. So really some great news for buyers. And sellers, hey, sellers, there is slightly more buyer activity right now. With rates easing, those borrowers have been sidelined. Guess what? They're getting back into the market. I already talked to you about first-time home buyers, 30%, 28 to 30%. So they're getting back in the market. They're seeing the news. They're getting out there. They want to take advantage of the buyer's markets that we're seeing across the country. Your pricing, it's stable. Your pricing hasn't dropped, sellers. Especially if you've owned the home for 3 to 5 years, you're going to have some equity in that home. Maybe giving that little bit of credit is going to be the difference between you selling your house and that neighbor 2 doors down is trying to sell the same house. This is that time that we're getting in that time of the year, that seasonable opportunity. In the military, we call it PCS Part 2, all right? Because most people, they move in the summer or they move right as school gets out at the end of the year. So the holiday demand typically picks up a little bit. I've always had pretty solid holiday months. Just simply because I don't take vacation. I'm always working and I'm always trying to help my prospective buyers find that home. And trust me, they are out there right now. This could be one of the better Christmas holiday seasons, all right, that we've seen in a long time. And hey, who wouldn't like a brand new house or a new home with a pretty Christmas bow wrapped around it? All right, that's all I got for you guys this week. Have a great weekend. Aloha.